Good morning, everybody. I hope you're ready for this online story. So let's quickly have a look at an example of how we're going to combine inventory valuation and insurance. Jelly Galore is an entity that sells jelly worms. The entity uses the weighted average method to calculate inventory. The entity also uses the perpetual inventory system. To date, Jelly Galore has only sold jelly worms in one standard packet size. It is aiming to sell a large variety of jelly sweets in different sizes in the future. Jelly Galore is not registered for VAT. Now, the following information is available for the year ended 31 December 2015, and let's just check what they want from us. Calculate the total cost of sales before the write-off of inventory to net realizable value for Jelly Galore for the year ended 31 December 2015. Same. Your calculation should be done in terms of packets. The average cost per unit must be rounded to 2 decimals. And then on the B side, calculate the value of the insurance claim in relation to the goods damaged in the hailstorm. Okay, so let's go back to the question. As at year end, the following information was available. Inventory in the beginning of the year, 600 boxes, 390,000. Guys, I've told you before, if you see any units in your question, you see a number of boxes, units, etc., then you know that you have to use a table format in order to prepare your answer. The reason for that is simple. You've got everything that you need right in front of you by using a table. Okay, as I've got the inventory 900 boxes, creditors in the beginning, creditors at the end. Inventory is bought in bulk in boxes. Each box contains 100 packets of jelly worms. Now, if you can remember correctly, they gave us the hint and they said, whenever you're going to work out unit prices, work in packets and not in boxes. So we have to convert all these boxes into packets, and there's 100 packets in a box. All inventories are bought on credit. The following purchases took place during the year. Now remember, we have to value inventory on the weighted average method, and they're using the perpetual inventory system. For that reason, we must know that all transactions that we're going to record have to be recorded in date format. Otherwise, your answer is not going to be right. So purchases, 20 May and 22 September. And then they give us a price and refer to note 2. And then sales, 15 March and 10 November. So when we then move on 22 September, 150 boxes were bought at 730 Rand per box. That's that note 1, 150 boxes at 730 Rand per box. Total delivery cost was 1,000 Rand, and we have received a 5% discount on the retail price. So that we have to work into our calculation. And then note number 2, they say the following cash sales took place. On 10 November, we have sold 200 packets, and that is note number 2. 50 of the packets acquired here on 22 September was actually damaged during a hailstorm on 31 October. Jelly Galore had insured the inventory for a total value of 500,000. Upon inspection of the damaged boxes, it was noted that some of the packets that were on top in the boxes were still usable, although it could not be sold in the normal course of business. 200 of these packets were sold to a local children's home at 4 Rand per packet on 10 November. The remaining damaged goods were thrown away. Now, what we said when we did insurance, we said, well, we can work out the value of the claim. We have the damaged of the insured amount. We can work out what was the theoretical closing inventory at the date of the hailstorm. We can work out what was the damage, because they said 50 of these 150 boxes that were purchased on that day were damaged, and we know what was the cost price of those packets, so we can work out the exact value of the inventory that was damaged. But then I say, if we can recover some money from that damaged stock that we can sell, we must actually deduct the sales proceeds of those items from the claim that we're going to submit to the insurer. Okay, so let's do the first thing, cost of sales. Now, if you ask me total cost of sales, it's just a different way of asking me each and every time, especially on the weighted average method, to do my full inventory for the year based on opening inventory plus the purchases, less the sales, and the closing inventory per se as well. So let's start with our opening inventory. We had 600 boxes at 390,000. We had in the beginning of the year 600 boxes at 390,000. They've told us to convert it into packets. So there's 100 packets in a box. So 600 times 100 gives us 60,000 Rand. What is our weighted average cost? Our weighted average cost at this point of time is the total cost of 390,000 divided by the number of packets, 60,000, which gives us 6.50 Rand per pocket. Good, if you go back to our transactions here, we will see that the first transaction that happens and took place after the 1st of January was this sales transaction on 15 March, and we have sold 30,000 packets. Is the selling price at this point of time applicable or relevant? No, it isn't, because now when they ask me sales, they want to know cost of sales, and I have to determine for the purposes of the inventory claim the closing inventory. So therefore, I'm not interested in the selling price, but I'm definitely interested in the cost of sales. So 30,000 packets was sold. When we have sold that 30,000 packets, at what price was those packets sold? Not the selling price. What was the cost price involved? And the cost price involved was the average cost per packet just before the sales transaction took place. So therefore 30,000 times 6.50 Rand gives us total cost of sales of 195,000 Rand. 30,000, the number of packets, times the average cost just before the sales transaction took place, 6.50 Rand, gave us cost of sales 195,000. Now, what is our inventory on hand after the sales transaction took place? It is our 390,000, the value of opening inventory, less the cost price of goods sold, 195,000, and that gives us still 195,000. 195,000 divided by the remaining 30,000, 60,000 less 30,000, 30,000 packets will give us 6.50 Rand per packet. Important principle come forward out of this. Whenever we sell something based on the weighted average method, the average price of closing inventory after the sales took place can never be different from what the average cost per inventory item was before the sales transaction has taken place. Good. Now, the next transaction took place on the 20th of May. On the 20th of May, we've purchased 500 boxes, i.e. 50,000 packets, and the total price 341,000 Rand. So purchased 50,000 packets, the purchase price was 341,000 Rand. What was the total number of packets available to sell after this purchase transaction? We had 30,000, we bought 50,000, so we had now 80,000 packets available to sell. What was the total cost price of those packets available to sell? That was then the total value on hand, 195,000 just before the purchase transaction, plus the purchases of 341,000. So the total value on hand, 536,000. What was the average cost? 536,000 divided by the number of packets of 80,000, and that gave us now a new average cost per unit of 6.70 Rand per unit. Good. The next transaction took place was on the 22nd of September, where we have purchased once more 150 packets. And I said refer to Note 1. Note 1 tells us on 22 September, 150 boxes were purchased at 730 Rand per box. Total delivery cost, remember we have to ignore that in this question. Total delivery cost amounted to 1,000 Rand. The supplier granted a 5% discount on the retail price. Good. 150 boxes equals 15,000 packets. Oh, go away. 15,000 packets. So 15,000 packets, 150 times 730 Rand per box gave us 109,500 Rand. Good. We had a 5% discount. So what you could have said directly is 150 times 730 times 95%. And that would have given you this amount, 109,500 less 5475. Now our delivery cost was R1,000, so that forms part of the capitalized cost of the inventory purchase. So if we work out the total value of that purchase, that gives us 105,025. For how many packets? For 15,000 packets. Now if we want to work out what was our total inventory on hand after this purchase transaction, we had 80,000. We bought 15,000, so we had available 95,000. Good. What is the total cost of that 95,000 packets? It was our previous 536,000 plus 105,000, which gives us in total 641,000 rand. Our new average cost per unit is now 641,000 divided by the total number of 95,000, and that gives us then R6.75 per packet. Good. The only remaining transaction that happened is on the 10th of November, where we have sold 200 packets. Now that was referring to this transaction here, where 200 packets was sold of the damaged stock. So 200 packets of these damaged stock was sold. The first thing that I'm interested is I'm busy with inventory. So I'm busy with cost of sales. I've got nothing to do now with selling price. So this is only purely cost, purchase cost and cost price of goods sold. So we've sold 2 boxes, which is 200 packets. What was the cost of sales? The last average selling price of R6.75 multiplied by the 200 packets, and that gives us 1,350. What is our stock that we still have on hand after we've sold that? 641,025 less 1,350 gives us 639,675. What is our average cost per unit? 639,675 divided by 94,800, and that still gives us R6.75 per packet. So you can see clearly here, after each and every purchase transaction, the average cost per unit have changed. Purchase transaction, what happened here is that the cost per unit have changed. With every sales transaction that took place, the cost per unit was the same as what it was before the sales transaction took place. Here you can see R6.75, a sales transaction took place, so our average cost per unit was the same as what it was before the sales transaction took place. So we can come to the conclusion then that only sales transactions will have no impact on the weighted average cost per unit, and only purchase transactions is going to change the average cost per unit. So if we're going to have a look at the first part of the question, they say calculate the total cost of sales before the write-off of the inventory to net realizable value. So cost of sales will then be the 195,000 plus the 1,350, which in total gives us the 196,350. Where does the net realizable value comes into play? The net realizable value comes into play here, that 50 boxes could not that was damaged. I have only sold 2 of those boxes, so 48 of those boxes cannot be sold anymore at a total cost price of whatever it was, because it has to be written off. Now, if we go back to the insurance claim first, let's say calculate the value of the insurance claim. We can going to do that on video number 2. So let's just stop here and I will continue on video 2.